Okay, we're going to continue with our statement of financial position. So we're now going to look at inventory with a cost of 7,000 has a net realisable value of 3,000. So this means that our inventory has gone down. So when we deal with that one, it means that our cost of goods sold is our debit. It's going to increase. And our inventory is our credit. It's going to decrease. And in this case, we're going to decrease that. It's gone from 7,000 to 3,000. So we're going to need to put it in at 4,000. Okay, so this happens because it's gone out of, may have no longer be fashionable. It might have got damaged. So our inventory is going to go from 40,000 to 36,000, and our cost of goods sold is going to have an extra 4,000. So 4,000. Okay, just check that we did that right. Now, right, so now we've got an invoice on hand. So always when we do an invoice on hand, we've got the two types. It's either accounts receivable or accounts payable. So invoice on hand, it's got two possibilities, accounts receivable, and the accounts receivable ones that are related to our sales if we are a trading firm, or our services if we are a service firm. So it's either going to be for sales for a trading one, or fees received if it's a service firm. But if the other type is accounts payable, and that relates to any expenses that we might have. Okay, and with these ones, you're always going to have three things involved in it. So if it was accounts receivable, our journal entry would be accounts receivable, be our debit for the full amount. Then we would have sales or fees received, which is our credit. And that would be for the GST exclusive amount, and then we'll have GST. If it's accounts payable, we're going to have whatever the expense name is our debit, and that's the GST exclusive amount, debit for GST, and a credit for our accounts payable. So if we look at the one we've got here, we're looking at delivery vehicle expenses 2,300. So in our case, this is going to be delivery vehicle expenses. Okay, our accounts payable is going to be the 2,300. Our delivery vehicle expense is going to be the GST exclusive amount, which is 2,000. And our GST is going to be the 300. So it's going to be debit delivery vehicle expenses. So we're going to increase that by 2,000. Going to increase accounts payable by 2,300. So that's going to be 30,300. And our GST is going to go down by 300. So that's just going to be 4,000 now. Right. Okay. We've got interest is owing on the mortgage at 6%. So with this one, we've got to find out how much interest we should have paid. So the mortgage is 60,000 and it's 6% per annum. So our mortgage is 60,000 and we should pay 6%. So we're going to find out what 6% of 60,000 is. It's 3,600. So 3,600 is how much we should pay. Let's have a look at interest on mortgage. How much did we actually pay? We paid 3,300. So that means that we owe another 300. So it's going to be an accrued expense. Okay, so our mortgage is going to increase to 3,600. So that's our debit. So interest on mortgage, there's our debit, 3,600. And our credit's going to be our accrued expense. So we're going to add another 300 to that. So we're going to get 1,300 for our accrued expenses. Right, next one is our depreciations. Okay. Right, we have depreciation on the delivery vehicle. DV is our diminishing value. So we need the carrying amount. So that's a historical cost of 70,000. So let's do our depreciation. And we're doing the diminishing value one. Okay, so that is historical cost minus accumulated depreciation. Okay, so that's going to be 70,000 minus accumulated depreciation is 30,000. And then we're going to multiply that by our diminishing value, which is 20%. So now we just need our calculator for that. So 70,000 minus 30,000 gives us 40,000, times that by 0.2, 20%. So our depreciation is going to be 8,000. Now with our depreciation, our debit is the depreciation on delivery vehicle. And that is, how much was it again? 8,000. That's our debit. And our credit is going to be adding that to accumulated depreciation to get 38,000. Right. Our depreciation on our warehouse equipment is just a 10% straight line. So our straight line is just our historical cost times our percentage. You might get a residual value so that you would take that off, or you might get a useful life. Yeah, so make sure you're aware of the other ways of calculating this. So historical cost for our warehouse equipment is 90,000. And then we're going to times it by our percentage, which is 10%. Times 0.1.